Most people think investing is complicated. They believe you need a financial advisor, insider knowledge, or to follow the latest trends. But what if I told you that the most successful investors, like Warren Buffett, made their wealth by going alone? That's right. The best value investors have one thing in common. They trust their own research, avoid the noise, and stick to a strategy. Here's a shocking fact. 80% of actively managed funds fail to beat the market over the long run, according to S&P Dow Jones Indices. That means the majority of experts out there are underperforming. So, why not take control of your own investments? In this video, we'll explore how you can find value, avoid common mistakes, and grow your wealth by trusting yourself. We'll show you how to think like a pro, pick the right stocks, and master the art of patience. No gimmicks, no shortcuts, just a proven strategy that's worked for the best. Stick around, and let's dive into how you can do it alone. Chapter 1. The Lone Wolf Advantage. Why going solo works in investing. When it comes to investing, you don't always need to follow the herd. In fact, some of the best investors, like Warren Buffett and Charlie Munger, have made their fortunes by thinking independently. The idea of doing it alone means trusting your own analysis, avoiding the noise of market trends and pundits. Investors who go their own way are often the ones who find value where others miss it. The lone wolf strategy requires confidence. A study by Vanguard found that individual investors who stick to their own strategies tend to outperform those who constantly adjust based on market buzz. When you invest solo, you aren't swayed by emotions or hype. You're building a strategy tailored to your goals, not someone else's. As Peter Lynch, a famous fund manager, said, the individual investor should act as his own advisor. This mindset has helped countless investors discover opportunities that others overlook. The more you rely on your own judgment, the better you become at identifying value in places others might dismiss. Chapter 2. Digging for gems. Finding hidden value in the shadows. Successful value investors don't just look at the stocks everyone is talking about. They look for hidden gems, companies that are undervalued and flying under the radar. Research shows that these lesser-known stocks often outperform the big names in the long run. A 2020 study by Morningstar found that small-cap stocks, companies with a market value under $2 billion, outperformed large-cap stocks by 3% annually over the last 20 years. One way to find these hidden opportunities is by looking for companies with strong fundamentals but weak stock prices. Focus on companies with low price-to-earnings (P/E) ratios, stable earnings, and a solid business model. These companies may be underappreciated but have significant growth potential. Sometimes, the best value investments are in industries that are temporarily out of favor. Think about how Amazon, Apple, and Netflix were once considered risky and undervalued before they skyrocketed. You don't need to follow the crowd. If you trust the numbers and do your research, the hidden gems will appear. Chapter 3. The Anti-FOMO Strategy. How to avoid the herd mentality. The fear of missing out, FOMO, can drive even the most rational investors to make poor decisions. We've all seen the headlines about the next big stock, and it's easy to get swept up in the excitement. But FOMO often leads to buying high and selling low. The best way to avoid this trap is by sticking to a strategy that works for you, not following the market's every move. In 2017, research by Dalbar found that the average investor underperformed the market by 5% annually over a 20-year period, mainly due to emotional decisions. That's because when everyone else is buying, the temptation to join in is powerful. But smart investors know that value investing is about buying when the market is fearful and selling when it's greedy. To avoid FOMO, it's important to have a clear investment plan. Know your risk tolerance and investment horizon. When you have a strategy and stick to it, you can resist the urge to jump into every trend that comes along. As Warren Buffett wisely put it, be fearful when others are greedy and greedy when others are fearful. If you're enjoying these tips, make sure to hit that subscribe button for more insights on how you can master value investing and build long-term wealth. Chapter 4. Patience pays. The power of waiting for the right moment. One of the biggest advantages of value investing is time. While others may panic and sell at the first sign of trouble, value investors know that the best returns often come from holding on through market ups and downs. Patience isn't just a virtue, it's a strategy. The stock market has historically risen over the long term. According to a report from JP Morgan, the S&P 500 has returned an average of 10% annually since 1926. But, as we all know, it's a bumpy ride. The key to value investing is staying focused on your long-term goals, even when the market feels like it's in turmoil. If you can ignore short-term volatility and stick to solid investments, you'll be rewarded over time. Buffett has said, "Our favorite holding period is forever." This patience and discipline is what separates successful value investors from those who get caught up in the day-to-day fluctuations of the market. Chapter 5. Your own risk profile. How to bet on yourself. Every investor is different. Some are comfortable taking on more risk, while others prefer a safer approach. Knowing your own risk profile is crucial to building a value investing strategy that works for you. This means assessing how much risk you can tolerate and how long you're willing to hold investments. A 2021 survey by Schwab found that 72% of investors with a clear understanding of their risk tolerance felt more confident in their investment decisions. Understanding your personal risk level helps you make decisions that align with your financial goals. You don't have to follow the trends or take risks you aren't comfortable with. When you know your risk tolerance, you're in a better position to make smart investments. If you're younger and have a long time horizon, you may be able to take on more risk. But if you're closer to retirement, you might want to focus on more stable, undervalued assets. Chapter 6. The freedom of control. Mastering your investment journey. The greatest advantage of value investing on your own is the freedom it provides. You're not tied to the advice of others or forced to follow the crowd. You are in control of your investment journey, and that control is powerful. As the legendary investor John Templeton once said, the 4 most dangerous words in investing are, "This time it's different." When you invest alone, you are empowered to build a strategy that works for you. You can adapt to changing market conditions and make decisions based on your own research and risk tolerance. There's no need to rely on financial advisors who might be more concerned about their commissions than your long-term goals. Mastering your investment journey means making decisions with confidence and knowing that you've done the homework. The path to financial independence is rarely linear, but with discipline, patience, and a well-researched strategy, you can achieve it. Don't forget to subscribe if you want more actionable tips on value investing and building wealth on your own terms. Your future self will thank you.